Hey, good morning, everybody. It's Hammer. Today is Thursday, August 14th, 2025. I, of course, am here with your daily mortgage rate update, the only place on the web where we get together and talk about what's going on with mortgage rates and pricing each and every weekday morning. Remember, if you'd like to join me live, you can join me at 9:30 a.m. Eastern Time. That's when the show starts. Generally, we run for about 20 minutes. We're on Facebook and on YouTube. If you're here this morning, say good morning. If you're watching on the replay, don't forget, give me a hashtag replay in the comments. Let me know that you were around. If you're on Facebook, don't forget to smash that like button. Maybe tag an originator friend in the comments. If you're on YouTube, don't forget to give us a thumbs up and subscribe. Remember, I appreciate all of your comments. It's a conversation, right? Also, it does help with engagement, so appreciate you there as well. If you'd like a quick text reminder that I'm going live, so you don't have to remind yourself each morning or depend on Facebook or YouTube to notify you, you can sign up for a quick text reminder, hmmr.io/reminder, or this cool QR code over here. It's absolutely free. We don't use your cell phone for any nefarious purposes. I don't sell your data. I don't ask you out on dates. Except for Kyle Mazegas. Kyle's kind of cute. So Kyle, you want to go on a date with me? I'm just kidding you. Anyway, what else we got going on this morning? All the regular stuff. So let's go ahead and say hi to all the live folks we got here this morning. We got Tom Stafford. Where is the guy who always says live from Louisville? I don't know anyone ever says live from Louisville. Good morning, Tom Dedmore and Kamazikas, Amy Blauser, Jerry Avila, Brian Mutter. Howdy, sir. Amy Blauser, great to see you. Nicole Semerad, good morning. Michael Love, Mike Brown, Mallory Fotiadas, Yasmin Martin, Mike Morano, Mike Tebow. A lot of Mikes. Kenny Rivard, Deb Dickinson, Will Patterson, Megan Bissell, Ray Stevens. Great to see all of you here this morning. Angela Walters, great to see you. So, all right, my friends, well, let's go ahead and get started. We're going to jump into the thick of it. So much to talk about today. What we're going to really go over is we're going to talk about the wholesale inflation data. Normally, it takes a backseat to the consumer inflation data, but this morning it came in hotter than McDonald's coffee, baby. And what that means for rates and pricing and why that's such a big deal. So we'll go into all that. I didn't have a chance to make a lot of my thirds down at the bottom, so you're going to have to just kind of follow along and pay attention. All right. With all that said, let's go ahead and get started and jump in. So if we take a look this morning, we can see that mortgage-backed securities currently down 6 basis points. We'll go into a little bit deeper on that in a minute. We'll talk about why that is. I mean, it's because of the wholesale inflation data. We'll talk about kind of where that's going, right? So quick recap, what happened yesterday. Yesterday, we saw a nice increase. We'll use green here. We saw a nice increase through the morning. Pricing came out right around 10 a.m. here and ended the day pretty much flat. We were kind of, right in that same realm right here. Not really much movement through the day. It was a calm day. Certainly, we'll give that a little bit of a thumbs up, smiley face. We like calm rather than bad. We did see improvement as lenders were coming out with pricing. Not really much of it that made it to the rate sheet. Wasn't much urgency going into this morning. Now, this morning, we started off with some nice gains. You had this jump in overnight trading. Things were ticking up. Again, this much higher than down here where we came out with pricing yesterday. It looked like we were in a position to see rate sheets that would have been better. That would have been such a nice, happy thing. And then what happened was right here, you could see this big dip, and I'll highlight it in red. This was due to the wholesale inflation data. And you could see there was some volatility. That's what that little spike is, right? But basically, when you take a look at this, we were here, we're down here. That's a negative. Now, compared to where pricing was yesterday, it's actually not that bad. It's a little bit worse. So you'll see rate sheets that are basically going to be they should be similar to yesterday, maybe a smidge worse, depending on where this goes from there. We need to kind of let the dust settle. So right now, mortgage bonds are down 6 basis points on the day. That's in the red. We don't like to see that. But that's not a huge move lower. And again, the reason that we're not panicking yet is because a lot of that movement, let me just go ahead and get rid of this. A lot of that movement, let's move this one. Come on. All right. A lot of that movement was due to, or a lot of that, those losses got absorbed because of early gains this morning. So that kind of put us in a little bit of a better position. So reprice risk on the day is moderate. We're really watching what's going on with mortgage bonds. They were down, they were flat, and now they're showing down 6 basis points. You can see that little tick right here. We're just going to see if that continues. We're going to watch that. So we want to see how the dust settles today. Now, let's talk about what happened and why. So the producer price index, it came in smoking hot, 0.9% after being basically unchanged in June. So the producer price index increased 0.9% from a month earlier after no change in June. And that was 3.3% higher than a year ago. Now, the main thing that's getting all the attention is the services sector, and that went up tremendously. The services sector jumped. Let's see, where do we have all this? Actually, we'll use here. So producer price index increased 0.9% from a month earlier after no change in June. The measure was 3.3 from a year ago. Service costs increased 1.1%, the most since March 2022. Within services, margins at wholesalers and retailers jumped 2%. Led by machinery and equipment wholesaling, goods prices, excluding food and energy, rose 0.4%. So what we saw on the wholesale side, vegetables coming in from other countries, fruits, vegetables, fresh foods, all going up. The cost of getting machines and equipment to build things all going up. This is all tariff-based. It's all tariff-based. There's really no way to argue against it. The report indicates companies are adjusting their pricing, and this is what I've been talking about the last few days. Reports indicate companies are adjusting their pricing of goods and services to help offset costs associated with higher tariffs, despite the softening of demand in the first half of the year. So companies are the ones that are eating the tariff costs right now. But the expectation is that eventually they'll be passing that on to the consumer side, which will lead to consumer inflation. This is the concern. What this does is it lowers the expectation of a Fed rate cut. Now, let's try to compare this to yesterday. Yesterday, there was expectation of a 50 basis point cut for September. Wasn't big. In fact, it was 5.72. So there was a 5% chance. Now we've seen that swing the other direction. And this morning, it's almost the same amount. Instead of 5%, that we would see 2 cuts or a 50 basis point cut in September. It is expected maybe we see no cut in September. The current probability of a September cut, markets still believe that the Fed is going to cut in September, despite this wholesale data coming in as strong as it did. Markets are still pricing in a September Fed rate cut. So there's not necessarily any need to panic lock anything at the moment. If we see this fall lower and the idea that we would get no rate cut if this column goes higher, that would be bad. All right. But we're not there yet. So we do want to keep watching and seeing where mortgage-backed securities go. Again, down a few basis points right now. Nothing to worry about. We get a second bite at the apple tomorrow. Let me make this smaller. Tomorrow, we're going to get some economic data. We're going to get a lot of, let me make this a little bigger now. All right. So tomorrow, hold on, let me make this smaller so I can change here we go, tomorrow. All right. So, and then we'll zoom in again. So tomorrow, we're going to get retail sales data. This is a big one. Retail sales. If it shows some weakness, that could help us a little bit. We're also going to get consumer sentiment data, and that one's going to be pretty big as well. And then some manufacturing data is kind of there. So the consumer sentiment data is really the key data there to see how people are feeling about the economy. And retail sales, are they actually spending money? So we get a little bit of a chance that we could see things get a little bit better tomorrow. I don't know how much better. I would definitely, when it comes to locking or floating, we're going to. I'll throw this on the screen on the bet on the there. So cautiously float to start, lock near term, and risk averse if bonds start to slide. So I'm going to put this up on the screen. My lock advice would be, let's float, right? So let's see where things go this morning. If we take a look at the 10-year treasury yield, it's not nearly as bad as it could be. I mean, we're still down 4.26. That's very low. When you look at, we were up at 4.29, 4.28. And then before the jobs data, we were in the 4.3s, 4.4s. So remember, here's that jobs data that pushed everything lower. We want to see bond yields go down. Down on the 10-year treasury is a good thing. So keep that in mind, right? It's the opposite of mortgage-backed securities. We saw a tick up. We're down this morning. You see that bounce higher. So, and in fact, let's zoom in on this so you guys can see this a little bit clearer. All right. So let's see. We'll zoom in. There we go. Zoom in nice and big for it. So taking a look here, we were down. Now we're back up. We're right here. We want to see where does it go from here. As long as we don't see it tick higher than, this 4.28 area, 4.29 area, we're okay. If it breaks above this, then it'll probably keep moving higher. And we don't want to see that. So that's what we're kind of watching for. And for mortgage bonds, you're watching here. And again, it doesn't really look like we want to keep too many things open, but you want to keep that option. Good morning, Charlie Bedita, Tim Klyla, Faye Escribano, Bill Stevens, Carmen, Harry Dennis, Mike Morano, and Ron Siegel. What do y'all think of the data and the reaction to the data? Again, producer prices rising by the most in 3 years. Usually, wholesale inflation data doesn't have a big effect coming a couple of days after the consumer data, but it did this morning because it is such a big thing. Also, another interesting article, Bessent says he's not pushing Fed rate cuts, just touting models. U.S. Treasury Secretary Scott Bessent said he isn't calling for a series of interest rate cuts, and that to get to a neutral rate, that it would be approximately 150 basis points. Fed Chair Jerome Powell said there are a range of views what the neutral rate is at this moment in our economy. So those are the takeaways in the article. I didn't tell the Fed what to do, Bessent said Thursday in an interview, referring to his comments about how the central bank could go into a series of rate cuts here. I believe there's room if one believes in the neutral rate for a series of cuts. I'm not calling for one. I didn't call for one. I just said a model of neutral rate is approximately 150 basis points lower. So he's taken a little bit more of a route of tact than Trump or Pulte does. So, which is partly why I respect him a lot more, and also I think of where he comes from. So we're going to keep an eye on this idea, though. Where is the expectation for Fed rate cuts? Again, yesterday we were at a 55% expectation that there would be 3 cuts by the end of the year, or 3/4 of a point cuts, and now that's down to about 40%, and it puts it pretty much neck and neck with the idea of 2 cuts here, 1 cut here. This would probably be like a September and a December cut, or maybe a September and November cut and done by December. So we'll see what that is. And CNBC says slight odds of a September cut decrease, but only slightly. Yeah, I mean, and that's what I'm showing you now, is it wasn't a huge difference. When we see expectations are still there that we're going to have 1 Fed rate cut. What we really saw the difference of was, is it going to be a 0.5 point cut? Or now there's a little bit of going the other way where there wouldn't be a cut at all. So next week, there's really nothing as far as economic data. That's one of the things that we're going to run into. Jackson Hole Symposium and Fed Chair Jerome Powell's comments there. That's what everyone is going to be looking at heading into there. If I've got a loan closing in the next week and a half, you're not going to wait all the way till next week to see. So I wouldn't really be all that into floating loans closing in the next 15 days. If I've got a loan closing by the end of August, I'm probably looking to lock it up. I mean, let's take a look at, I'll show the the Mortgage News Daily, you've seen some different arguments about how we've had the best rates that we've had this year. You're talking just tenths of a point to get there, though. 6.53 versus the idea. Hold on, I'm going to put my pretty face up here. 6.53 versus 6.55. Even this morning, if we're not going to see yesterday's rate sheet, but you're not going to be any worse than you were a couple of days before, and you're probably going to be coming in right about here. So why not? Why not lock these rates up and call it a day? Let's wait and see. Let's see if markets settle and see here. Now, how do you keep track of this? Well, I'm glad you asked. You want to make sure you're getting our text lock alerts. So we've got our lock advice. We send out a morning alert around 10 a.m. Eastern time. We do a wrap up between 4 and 5 p.m. Eastern time on the market. And let's say today that this were to go negative and reprice risk were to increase. I'm telling you that you want to be floating, but you want to lock if things get worse. How do you know if things get worse? You don't have to spend $50 or $100 or $150 a month on one of these services to monitor it real time and try to figure out what all these fancy Japanese candlesticks say. You can go ahead and grab our text alerts, and I'll show you what our text alerts look like real quick. Here you go. And just a nice, quick, easy text alert like this, an opening telling you what's going on, what the reprice risk on the day is, a little bit of a summary, and then at the end of the day, we'll give you a wrap up. And if it looks like the market's going to move and things are at risk of moving, you're going to get an alert like this. Bonds drifting lower. If you plan on locking anything, do it ahead of possible reprices to come. So if you want to protect your pipeline, check us out at ratetextalerts.com or use the school QR code. If you're on your phone right now, take a screenshot, go to your photos. That QR code will work. $7 a month. Haven't raised the price in forever. Don't plan on raising it anytime soon. And there's no tricks, no fees, no startups, no anything. You can just sign up and you're good to go. $7 a month. So cancel anytime. Check those out. Also, if you'd like to get our daily lock advice email, that is free. You can get that at ratelockadvice.com. If you're looking to grow your social presence, check out Grab and Go Social. If you want to build your brand online, start getting loans from Google and AI search, check out originatorssuccess.com. So, all right, my friends. Well, that's it for me. Let me know in the comments what you guys think. Hopefully you found some value today. If you did get some value out of today, please let me know in the comments. Always appreciate that. And otherwise, tomorrow we'll see what some of that other stuff happens. I don't think we're in danger of seeing rates really move higher, but we aren't necessarily in a spot to see move lower. If loans have more time, I didn't really say this before, so I'll say it now. I mean, if you close in 30 days, we want to see where that September, that next labor market BLS jobs report comes in on September 5th. We'll see what Powell says at Jackson Hole. Then September 5th and that BLS jobs report, that's going to be a big deal. If we see signs of weakness, it's going to be a big deal. I'm curious to see what will happen on that one, though. So, all right, my friends, y'all have a fantastic one. I'll see you tomorrow. Take care, everybody. Bye-bye.